Your Money in Business is made by MPT to serve all of our diverse communities and is made possible by the generous support of our members. Thank you.
Just ahead, steering the state retirement and pension fund in a volatile market. An Annapolis eatery celebrating 50 years of food and politics. And the importance of diversity in the workplace and in the boardroom. It's all next.
Your Money in Business starts now.
Hello, and thanks for joining us. I'm Jeff Salkin. We begin this week with the challenge of running a multi-billion-dollar investment account. Joining us is Andy Palmer, CIO for the Maryland State Retirement and Pension System. Andy, thanks for being with us.
Oh, it's a pleasure. Thank you, Jeff.
CIO is Chief Investment Officer of about $45 billion.
That's correct, yes.
How long have you been in this position?
This is my, today is 2 months. 2 months
So
today.
a veteran.
Yeah, I'm a veteran, yeah. My years of experience are condensed into 2 months. Yeah.
What did you do before this?
So before this, I was working for the Tennessee Consolidated Retirement System in the Tennessee Treasurer's Office. It was a similar size plan, about $45 billion. There, I was the Deputy Chief Investment Officer, had similar type of responsibilities.
So all of these tens of billions of dollars, who do they belong to?
Oh, they belong to the retirees in the respective states. So these are state plans. They're comprised, both states are similar in that they were consolidated plans, which means they're comprised of state employees, teacher retirement systems, and a lot of municipal governments are also involved in different plans. So they all have their own, and police and firemen, things like that. They all have their own pension plan, but we invest them together as one.
Many people watching us hopefully have retirement plans of their own, maybe measured in the thousands of dollars. How does one think about managing billions of dollars? Well,
there's two differences that I think of right off the bat. One is that for a pension plan, we are an infinitely long-lived organization. So if you're a person and you're planning for your retirement, you have a horizon. You're going to live 120 years, hopefully, but there's an end date where you're planning for your money to last. For us, we have to think about a long-term horizon, and we need to generate a return of about 7.55% for Maryland in order to meet the obligations that are building under the employees' contracts with the pension.
So what's the strategy? How do you go about hitting that target?
So we look into the world for investment opportunities, and we try to assemble a mix of investments that will, one, grow enough to meet that 7.5% return, and two, be diversified enough so that when markets are volatile like they are today, we are able to protect value. Because it's important not only the return you have over time, but the path in which that return takes. So it's much better to have a slow and steady return than it is to have large fluctuations in value, because even if at the end of a period you have a similar compound rate of return, you'll wind up with a bit more money if it's less volatile. So we're trying to take the volatility out of that. That
target that you cited, 7.5% more or less, as an investment professional, is that a reasonable number?
I think it is, yes. Largely, the difficulty right now is that interest rates are so low that that used to be a big portion of the part that drove returns. So 15 years ago, when 10-year Treasury rates were 6%, it wasn't that hard to envision that you would make 7.5%. Today, the 10-year Treasury rate is below 2.2%, and so it's much harder for the rest of the portfolio to earn that. So what pension plans have done is that they diversified away somewhat from their Treasury and government corporate bond portfolios into different kinds of investments to try to generate returns that are close to what bonds would have produced in the past.
Give us an idea. You said it's diversified, but where are the big chunks of money?
So still the big chunks of money are in public market equity. So the Maryland plan has around 35% allocated to global stocks. Other plans may have a little bit more, but we have about 35% there. We have 10% in private equity, so it's investments in private companies through private equity general partners, and they're trying to change the companies and create growth that way. We do have about 25% in fixed income investments of different types, whether it's treasury bonds or corporate bonds or mortgage-backed securities. Those provide relatively stable income streams and a differentiated return stream than treasuries. Pension plans have an opportunity to invest in different kinds of alternatives which individuals don't have. For instance, we do use what's called hedge funds in our portfolio, and they tend to have a connotation of being risky investments. And the reason they're called hedge fund is the hedge part is supposed to take out risk. So most of them, and in a portfolio of them, you'll have a lower return volatility, so the return won't bounce around as much as it would in a regular stock portfolio, and hopefully they can find strategies that will give us a modest but steady return over time.
Now, some pension funds, CalPERS notably, announced it was going to get rid of its hedge funds. Is that a trend that you think that other funds might follow?
I think you have to examine your program, and part of the reason for CalPERS is that they're a giant fund. And what hedge funds are trying to do is find inefficiencies in the market. And so if you take 10% of a giant fund, it's a lot of money to try to put into the hedge fund world where you're trying to find small inefficiencies. So in order for them to implement a strategy, they had to go to so many managers that they would wind up with one manager with a trade that would be benefit if this thing happened, and then another manager would have the opposite trade on.
So they were on both sides of the trade,
they would
and
cancel each other out.
They're getting charged for both sides.
So I don't know the details for them, but I imagine that it was difficult to find enough exposure to trades that were differentiated to make it worth their while. And it does have a fair amount of fees. So if you wind up paying a lot of fees and then the returns are kind of diversified away, then it's not a very good strategy for you. So you can try some different things.
How do you think about the fees and how much different investments cost?
I think about fees as an economic rent. So I'm a recovering economist from my graduate school days. And so the ability to make money in investments on in something other than just getting rewarded for taking risks. So if you put your money in an S&P 500 index fund, you would expect that over time you're going to get some reward for taking the equity risk that's there. So in order to make money in addition to that risk or different from that risk, it takes some skill. And so if we're hiring managers that have a particular skill, the good ones can charge a high fee because their services are in demand, and they can't. There's a limit to how much they can invest in one strategy. They can't be a $100 billion investor in a particular strategy because they'll drive the return to zero.
We hear in Annapolis in fiscal debates that the state pension system is underfunded to some degree.
Yes.
What are the numbers like, and how big a concern is that?
The numbers I've seen are that the plan is about $19 billion underfunded on a base of $45 billion. That's a large number. It's not insurmountable. There's a process that's in place. The legislature has agreed to it to fund the pension plan according to its actuarial required amount for whatever it's needed. And actually, they've agreed to put in additional amounts in past sessions in order to help us close that gap. So we expect that the plan will be more than 80% funded by in the 2020s and be moving toward fully funded in probably the 2030s. Seems like a long time, but that's in pension time. That's a snap of the finger.
How do we compare to other states in that regard?
Probably in the middle of the pack. And the big differential traditionally has been in the funding part of it. States where they've taken funding holidays or have funded at different levels than full funding have found themselves in that predicament where they're kind of unfunded now. States like Tennessee, for instance, where they've always funded their full amount, they are in the 90s in terms of percent of being funded. So it's a combination of what the benefit structure is, if when benefits are increased, if they make sure there's a function to pay for them, and The second piece is consistently funding it, and the third piece is meeting your actual return requirement from the investment side.
Now,
that's where I come in. Yeah.
You've been in the job now for all of 2 months, but are there any changes that you have made or you're contemplating at this point?
We are working a little bit with the board to think about our asset allocation. One of the things that I worry about as an investor is the risk of deflation, particularly for a pension plan. If you're in a deflationary environment, you have a set of liabilities that are out there that don't change very much. But if you have deflation, asset values tend to drop, and it becomes harder and harder to meet those obligations. So I didn't think we had enough protection in the plan against the deflation, and so we've changed it, tweaked it a little bit to add a little bit more protection there.
Very good. Andy Palmer is the CIO of the Maryland Pension Fund. We thank you for coming by.
Oh, it's my pleasure.
Appreciate it. And now, in a city known for its history, one small restaurant on Main Street, Annapolis, is celebrating an anniversary that is 50 years in the making. Josh Davidsburg visits Chicken Ruth's Deli.
Routine and tradition are a part of Chicken Ruth's Deli.
Daily. I recommend 4 to 5 days a week. We all get in here generally between 7:30.
For the past 50 years, the restaurant aesthetic hasn't changed.
I'm just proud and happy that we can run an old-fashioned family business still today in the year 2015.
And neither
We don't have any life.
has some of the customers.
Oh boy. The locals get here a little earlier. You know, it's a tourists sleep in. Solve all the problems of the world. Create a whole bunch more of them. We had chicken wings and pickles.
Since 1976, Skip Strovel and his friends have sat in one of these booths.
They're listening. I can't say how great they are yet. Well, the friends leave a lot to be desired. Well, that's debatable.
Some days, the Breakfast Club includes a sitting governor.
You can be on a name basis with them.
And because the governors come in, a lot of the other politicians, senators, delegates, lobbyists, they all follow behind them. Can you count pretty good, young man?
Ted Levitt doesn't get a lot of time to contribute to the conversation. He's the deli's owner.
It's like a dream come true. Growing up my whole life, I worked here with my parents.
Levitt took over for his father after he passed away in 1995. He's expanded into fresh-baked breads, donuts, and pies, but kept the secret ingredient to success.
My parents taught me in the old-fashioned way. It's all about service. Service.
About 700 people come to Chicken Ruth's every day to eat lunch. On the weekends, it's more like 1,100. The staff here says that everyone who comes through these doors and sits at this counter is like family.
Jeff, you want a little more coffee?
And as the restaurant celebrates the 50-year anniversary, that family extends to the staff, some of whom have worked at the deli for more than a decade.
Is that all right? Okay. Totally blessed. I'm glad I'm still able to do it. It's a little bit tougher. You know, I'm getting older, and there's a couple more body aches. But as long as God lets me do this, I'm not going anywhere. Here you go, Amelia.
Levitt loves the saying.
If you enjoy what you do, you never work a day in your life. Say abracadabra. Abracadabra. Tap it twice.
It's obvious to his whole extended family, anyone who eats at Chicken Ruth's, that's true. He's never had to work a day in his life, no matter how hard he works to keep his customers happy.
I got it. Don't worry.
I'm Josh Davidsburg.
There you go. Do you feel a lot better?
For Your Money in Business.
Put that in your sister's ear, buddy.
For this week's Smith Business Close-Up, we're on location here at the University of Maryland. And joining us at the Robert H. Smith School of Business is Professor Hank Boyd, who is the Smith School's diversity officer and a clinical professor of marketing. Thank you for being with us.
It's great to be back.
Our topic is diversity in business. You have an event coming up aimed at improving corporate diversity. What's the objective?
Well, the objective for this event, we're very excited, is our second diversity fireside chat. So we began this concept of saying, let's bring in people from the private sector, from government, who can speak to issues in diversity. So last year we had Veronica Villalobos, and she came out and spoke what the government's trying to do in terms of diversity, Office of Personnel Management. And this year, hold on to your hats, John Rogers from Ariel Capital, and he is a legend in terms of investing, African American, starting his own firm, and we're just gratified to have him here at the Smith School.
That's a big name, and somebody, I'm guessing, who would have the opportunity to sit on almost any corporate board that he would want.
That is correct. He's on the board of McDonald's, to give you a sense of things. So we're talking Fortune 500. And his insights, in particular, when we start talking about diversity, if you are an officer and you happen to be a person of color, what are your responsibilities and duties for the corporation?